For more on these markets, I'm bringing into the conversation Moody's chief economist, John Lonski. It's good to see you.
Same here,
Good day to have you here. The economy's good, right?
Yes, it is. It's very good. And earnings are great. They'll grow by 18 to 20% this year.
So are people overreacting? I mean, I'm saying to myself, the market is looking at these wild fluctuations. I mean, down thousands of points just in the last week and a half. And yet we're looking at strong economic growth. We're looking at strong wage growth. We're looking at, people getting jobs. So how do you explain it?
The earnings are going to be there. We're also looking at stronger corporate balance sheets. We see the bankruptcy rate or default rate going down throughout this year. I don't know what's going on. They're worried about inflation. My God, a 2.9% yearly increase by the average wage pales in comparison what we had in the 1990s. At one time in the 90s, we had the average wage go up from about 2% to 4%. But at the same time, core PCE price index inflation fell from more than 3% to just under 2%. The correlation between wage growth and core inflation is practically non-existent.
Oh, wait, so you're telling me then the Fed may not have to move? In other words,
well, they're going to move. They're going to try to normalize monetary policy. The market expects a Fed funds rate something above 2% by the end of the year. Big deal. Look at the price of oil right now of late. Price of oil now is under $59 per barrel. Not too long ago, it was about, $65 per barrel? That's moving lower. If the price of oil is moving lower, it's going to be very hard to have much of a lasting acceleration by PCE price index inflation.
Let's see if we can pull up a chart of the dollar. In yesterday's session, just 24 hours ago, it was moving higher. Which you think is kind of a logical move, right? The dollar should get stronger if the Fed is going to be more proactive, and in fact, the economy is getting that much better.
I think where we had a problem is the 10-year Treasury yield got ahead of itself. But we were, magically, if the 10-year Treasury yield came back down to about 2.6%, the market would steady and would perhaps rise. But unfortunately, they looked at that jobs report. They looked at some of these industrial commodities, and they said, oh, my goodness, inflation is here. It's going to murder us. We're going to be looking at 4 rate hikes, and we'll be looking at a Fed funds rate 2019 of 3 or 4%. I can't take this, so let's get out.
Okay, let me back up then. So you're saying, sure, we can have wage inflation, and that's good. That's good for the economy. It doesn't necessarily translate into inflation for goods and services.
Precisely.
Okay. So let's fast forward then. So the Fed theoretically then stays on course doing its normal thing. If it doesn't see a lot of inflation, it just moves to get off of zero. And, well, the market should then respond in kind.
I can state with confidence that if we do have this declining bankruptcy rate, if profits grow by 15 to 20%, and if Fed funds finishes the year no higher than 2.125%, the equity market will be higher at year's end than it was the previous year.
Well, look at this. John, someone's listening to you because we're now up nearly 60 points right now on the Dow, 75. So it could just keep on climbing here. How do you justify this
algos don't listen, though. Programs don't listen. So I think that's one of your big problems. What's very interesting, what's going on now? You noted earlier the VIX index is a measure of fear or risk in the equity market. Its long-term average is about 16 points. It's down, 35 points. But on the other hand, if I go to the corporate bond market, we have another measure of risk. It's called the junk bond yield spread. Say 500 points is the long-term average. That spread is now well under its long-term average still. It's less than 400 points. So you have a below-average fear factor in the corporate bond market and a well-above-average fear factor in the equity market.
What's that say?
This is crazy. I blame a lot of that again. Algos. In other words, the corporate bond market's less liquid. They don't do algorithmic trading in the corporate bond market. They do it in the equity market, and it's amplified this latest period of stress.
We're blaming the computers. We're blaming the robots.
And, they got us into a lot of trouble with subprime mortgages, too.
Yeah, they did
the programming or the mathematical.
But that's interesting that it's not as active a play there in the corporate bond market.
No,
so good. Okay, John Lonski, thank you so much.